Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for week ending April the 11th, 2014. Let's take a couple views here of the markets right now. We had a very interesting week, and I guess what's on everybody's mind is just how low can we go? Well, if I scale this thing out again, you can see that we go into starting in Q4 of 2013 or 2012. We've had this nice ascending channel here that the E-mini futures has fit in. You can see very nicely as I just let me just adjust this on the screen here. You can see how it has flowed from left to right across the screen in an upward fashion. The vector is very obvious here. The other thing that you can see on here is my both my 200 EMA, which is the yellow, and the 50 EMA, which is the red. The 50 EMA is pretty much kind of bisected the center of this channel until we get in right up in this trouble zone right here. And the 200 EMA has pretty much ran an upward vector as well, just paralleling the channel as we've been going up. And this is, pretty much for the entire part of 2013. Now, I said as we go into 2014, it's going to be an entirely different year than 2013 as far as which markets are leading the way and which ones start to fall in reserve. And it's pretty much played out the way that I've talked about here. And, a lot of our members are, taking advantage of that. Now, we've had a couple of really hard down days. So let's take a look at a couple of key things that, is kind of hitting my desk right now and what I'm looking at. So let me just blow this up for you. And let's get it a little bit more in perspective just so that you can see. Now, the key question that everybody has is that, okay, we're having a nice little pullback here, right? We're at a key support area at 1812.50. We blew through this first support zone at 1846.50. Now, these are the E-mini futures. And we blew through also the 50 EMA here. And notice the 50 EMA has now started to get a downward vector on it. The 200 EMA has still got an upward vector on it. So, we're moving somewhere into this vicinity right here where if we keep this up, it's going to be, one of those kind of death crosses. I don't think that's going to happen. I think the U.S. market is really still expanding, albeit very slowly, and I think we're getting into some profit taking. And we just broke the upsloping, the lower band of the channel here on Friday. So, but we've had a couple of really bad down days on Thursday and Friday. Some really strong ones. So the week is just not finished off very well. But let's take a look at the prior downside action that we had. That was fairly swift. You can see this point right there, from this high here, which is pretty much very similar to that high right there. We pulled down and hit 1732. So if I were to measure that and say, well, how long did it take? What's the bar count? And again, this is a daily chart. And what is the percentage of the loss? Well, then I can just come in here and select, let's just select the key attributes. And if I were to come down and show you right at that area right there, boom, it took really 9 bars to get down there. So really, when you look at this, that's 9 days to go from there down to that key point there before we had that reversal. And it was a little over a 6% pullback, okay? And you can see the trajectory. It was a -12 slope. So that was a fairly quick, rapid down move. Now, if we were to duplicate that right here, where would that put us down in this area here? Where would it show up? So it's very easy for me to just come in here and then duplicate that line and then just simply move it over here like that from the high, like that, let it lock in. And you can see here that if we were to have the exact same downward move, you can see here 112 points if it fits exactly. And in this case, it's only 5.92%. Why? Because we're at a higher price. So as a percentage, the drop would be less. But it would put us nonetheless right at that level right there, which is at 1780. That's assuming we have the exact same pullback time and duration and depth as we had before from right here. Now, I don't think it's going to copy it, but that just gives you an idea. The other thing that it does is it shows that the time to get there would be April 17th, which would be sometime next week. assuming that it falls at the velocity that we did here. Now, of course, it can get a lot worse, and we can run all the way down and continue down, continue onward. But I wanted to just give you an idea of where some key attributes are in this down move. Now, the other thing that I will point out here is as I zoom in here, I said 17, roughly 1780. You see, I've got a natural sitting right here. Well, that didn't come in right, did it? I've got another natural price zone sitting right here at 1773.25. So that's very close to right there. That's a natural price level that held up. And we could find a sticky wicket there, which is just slightly above the 200 EMA, which is sitting at 1757. Remember, as we move forward in time, the 200 EMA continues to rise up slightly. So right now for the E-minis, I'm saying that, if I get these off the screen just to get them out of the way here, you can just get an idea of what the potential is. Now, to show you what a potential, I'm hearing a lot of people say, well, we need a 10% correction. We haven't had a 10% correction in quite some time. Well, if I were to just kind of show you where that would put it, I could do the same thing and just come in here and choose this and say, where would a 10% correction take us? And I can just move all the way down, and it puts us right about in that area there, right there. Let's call it there. And if you'll notice, a 10% correction puts us almost right on top of that key price level, 1705. Now, again, forget the slope or the vector. I'm just looking at right now the level at 189 points off of the high. 189.18 would give us about a 10% correction from the all-time highs here in the E-minis. And that puts us right on this key point, which really is a little bit concerning because it takes out that key pivot there sitting at 1732. That is a key pivot of the lows made in late January, early February as we started that hard bounce. So this just gives you an idea. And by the way, if we pull back to this 10% level here, which is about 100, let's call it 190 points, sitting at 1705 roughly. You got that psychological barrier at 1700. But that would be a 10% pullback, and we would still be in an uptrend, right? This is just a profit-taking mode. Now, are we going to get down there? Nobody knows. You'll hear a lot of people guessing. You'll hear a lot of people saying, well, I think it's going to do this. I think it's going to do that. At the end of the day, our members don't really care. What we care about is following price action. And price action can take this thing anywhere. What we're going to do, and what I'm going to have our members do in our chat room, is we're going to play it the same way we played this move here. And we're going to look at a certain combination of indicators to see if we can jump in on a potential bounce. Now, as you guys know, the market's just not going to go like that. All right, even if we get that 10% pullback, it will not do that. What'll probably happen if we do get a 10% pullback is we'll probably do one of these things and we'll have a fake out. We'll move up. We'll probably hit some natural resistance point like the trend line or like this 1846.50. And then we'll roll back, and then we may come back, and then we may do one of these kind of things like that, which gives us a little bit of a downsloping channel like that. And the next thing you know, over the next month or two or three, we've peeled back 10 to 12%, or maybe even all the way down to 1661, which is what I was calling back over in this area here for a pullback of around 1661. So I'm not really sure where it's going to go, but we're going to test the waters on some of these counter trend moves as it's moving back up, because you never know. If it may break through and come all the way back up, test this and take it out and keep right on running. No one really knows, because this is the side of the chart that you trade, and right now you don't know which way it's going to go. You don't know if it's going to do one of those things or it's going to do one of those things and make you happy if you're long or sad if you're short. So this is kind of how we're going to be watching this and playing it out. Now, the other thing that I wanted to point out is if we come in and we take a look at the Dow, you'll see I've got those indicators on the Dow right now. Notice we had a pullback going from, and the Dow lags the rest of the markets both up and down. Meaning the Dow is mostly the biggest cap, only 30 companies. big dividend paying. So if the market is in a risk off where everybody's putting money in, they're not putting it in the big cap value oriented type of play. They're putting it in the smaller cap, mid cap, and growth stocks as opposed to value stocks. You can see here the Dow had a pretty good sell off back here when we had that sell off going into February, and then the Dow bounced. But and if we do the exact same thing, because we just this past Friday challenged and took out the highs, not this past Friday, but last Friday, a week from yesterday, we just took out the highs that the Dow made at the end of the year of 2013. Remember, the S&P 500, NASDAQ, and the RUT had long passed the highs of December 31st, but not the Dow. It just did it about a week or so ago. But if we have the exact same pullback again that we had there, again, roughly 24 bar count, that's almost a month and 4 days, right? Is the daily chart. Gives us about a 7.63, 7.4, and it challenges that key pivot right there. All right, so that's kind of takes us right back down to that area again. I don't think we're going to go much lower than that because we still have to take out the 200 EMA sitting right there at this point in time, 15.7. We've already cleared the 50 EMA. We took out that key prior pivot point right there. So we got a little bit of testing to do, but money will flow into the Dow, bigger dividend paying stocks. I do believe the Dow is going to fall less than the other markets. And part of the reason is we're getting a dramatic turn up in bonds, which means yields are going down dramatically. And if interest rates go down, money's going to flow to the dividend paying stocks, which a lot of them are in the Dow, which supports the Dow. So you're going to see the Dow not lead the way down nor lead the way up. So money's flowing into the Dow because this downdraft is not as strong. Now, let's go look at some of the other markets that tend to lead the way up and lead the way down. Look at the Russell. I mean, this is clearly just, it's in a world of hurt right now. You can see if I zoom out like we did with the E-mini, you can see the Russell the entire year of 2013. And if I were to box this in, right? If I were to just box this in 2013, right there, that is the year 2013. Right, so you can see, or I probably should include that as well, right? So that's all of 2013. You can see the rut has really, it never really on this daily chart violated a daily close below that lower channel. I mean, it basically stayed, it basically stayed right with that 50 EMA all the way up, which kind of hugged the bottom of the channel, but you can see the rut was the inside this channel pretty much the whole way. And it wasn't until this past February that the rut really violated that channel, formed that key pivot there at 1078. We're now probably going to challenge that. It's sitting right on the 200 EMA again. Folks, if we break that area right there, we're going for a hayride. And it's going to be a nice hayride down. You're going to see more panic come back into the market. You're going to see the volatility go up even more. If I blow this up, again, this is the Russell, you can see right here where we're sitting just north of the 200 EMA there. And then that key pivot. So I'm looking for this key pivot to hold. If it does not hold, that means there's going to be more downside action across all markets. So remember, the rut leads the way down, and it'll help lead the way up. Same thing with NASDAQ. You're going to see the same damage in NASDAQ. We're on this key level here with NASDAQ. This is a key pivot here at roughly, let's call it 3,400. The official number is 3401.75. But you can see where we're sitting there, just north of the 200 EMA, just north of the key pivot, that sits right over there. So we're at some key inflection points for both the NASDAQ and the Russell. So I would encourage you to really watch these two charts. And if we get a bounce and we get a hold here and it starts to kind of consolidate, it'll be choppy, right? And then it'll consolidate and start to move up. That'll be bullish for the other markets. So that's what I'm going to be looking for. The other thing is, if we kind of go over and just take a look at volatility real quick, this daily chart of vol, you can see here I've isolated a couple of things. You can see right here that, and this is a daily chart. This goes all the way back to Q1 of 2013. You can see we've had, a couple of spikes involved where we've hit this downsloping trend line. And then we have minor spikes like these here. And you can see I've kind of highlighted it with this shaded area here where these minor spikes, it tends to cool down generally. It's only been just a few times that we blew up above those minor spikes, just a few times, and we were only there for 3 or 4 days. Now, this has been the entire year of 2013, including the February downdraft where we got all the way up to this level here. Now, that's not to say that we know what's going to happen here, but the odds favor, once we get in this area, it's either going to happen very quickly where we come back up and we challenge this area here, which would probably be challenging this level right here, right? Which is right at that level there, which is right at that level there. So these are very similar here. And it'll only take a few days to get there. And I would consider that a capitulation move. If we get up there, I'm going to be shorting volatility. Right now, I got my finger on the short, but I'm not pulling it yet because we could just bounce right up and go from the for volatility closed at 17. It was up only 7% on Friday. You would expected a bigger one, but it's only up to 17 right now, 1703. We're sitting right there just south of that resistance zone right there. So I'm watching for this thing. I'm not going to short it just yet because I don't believe this downdraft is really done yet. I think we got a little bit more to go, a little bit more shakeout. And I noticed that on Friday and Thursday, some of the sentiment was a little bit different. Every time the market tried to do a rally, there were selling on the rally. The sentiment in the market for the entire year of 2013, anytime there was a pullback, there were buyers on pullback. Now in the rally, there's no more buyers to drive the rally higher. There's more sellers. So I think a lot of the money is on the sidelines or is sitting in a safe haven like the Dow or bonds, waiting to have this thing sell off more. And there's going to be some great buy in there. Keep in mind, we've had a big rotational shift, sector shift. And I like to use ratio charts to take a look at these things. And one of my favorite ratio charts is, well, is risk on or is risk off? There's two great charts for that. One of them is the consumer discretionary over the consumer staples. So now it's a ratio chart here. So I've divided XLY over XLP. Now you can look, I've talked about this with our members for quite some time, but starting right in this area right there, this is the entire month right there of March going into April the 11th. You can see this entire time, this chart essentially with one little exception has been in a downward pattern, just like that. And I could draw it on there and it would, it'd be the down channel like that. When this chart goes down, risk is being sucked out of the market because typically consumer staples, food products, things like that, that people have to have no matter what's going on, will do better and money will flow in there better than discretionary like big screen TVs and jet skis. So people are conserving money. So when this goes down, risk is coming out of the market. Well, this actually started in March, and by about the middle of March, I was pointing out to people that we're getting in a very tenuous situation. So start reducing your longs, start hedging your longs if you want to stay in it, or start looking at some downside action because this is kind of where we're sitting right now. The other one that I love to look at, that it's a ratio chart that measures risk coming in and going out of the market, is this one right here. IVW over IVE. Now here's another one, and look at this one. It almost looks exactly like the other chart. You're going to see them very, very similar. But if I take a look at where we are, right now, guarding from the beginning of March to present day right here, I mean, a 3-year-old knows that this chart has been, pretty much in a free-for-all. Well, IVE is growth-oriented ETF, right? So I'm sorry, it's a value or growth rather. It's a growth-oriented ETF, and I put that again as a ratio chart over a value ETF. Now these are ETFs that track an index of stocks that are deemed value stocks versus growth stocks like Google or some of these biotechs or other really fast ones, Twitter or some of the tech stocks, some of the other ones, are viewed as growth stocks. Typically a PE ratio, that's north of 20, 30, 40, 50, 60, something like that. High PE. Value stocks, the PE ratio is down around 10, 7, 8, 12, something like that. So value. So when this chart is going down, money is being sucked out of growth and it's coming into value. And so that means this is another risk off kind of ratio chart that you guys can use. So we've had early warning, and I've pointed this out to our members since the second week in March, to be very careful because the markets are just not showing all of this upward movement and all-time highs is being supported by all the various stocks. And then we had that rollover in Russell and NASDAQ first, and it was a lot more severe. And when you start getting some divergences in the major indexes, then you've got issues, right? I mean, you've got big issues. And then finally, one that I like to look at, here's the utility sector. Now, the utility sector, money's been flowing into the utility sector all year long. That is 2014. That is the chart of a stock. If I were to, forget what I told you, I said, what do you think about this chart? You'd look at that and you'd say, man, that's a growth stock. That thing is taking off like crazy while the market is going down. And you may say, is that an inverse ETF that goes the inverse of the S&P? I'd say no. This is XLU, a utility. Now, this guy is the most boring of boring. It's like bonds. But when you see something like this, and I've been pointing it out to our members, when you've got utilities being the top performing sector for 2014 and you're making all-time highs, something ain't right, folks. It's not adding up. And we're getting that right now. And that means that I think there could be some more downside action before this thing's done. Now, once this thing starts to bottom, the markets and it starts to move higher, for those of you intrepid people, you can take a look at this thing and then say, okay, well, that means if that's the case, money's got to come back out. And if money comes back out, it's going to go in that direction. So, playing shorts in XLU could be a sensible move over the next week or two if we get a nice little counter trend move. Right now, our trend and bias is down. So any up move, we have to assume there's going to be sellers into the rally. That's what you got to assume. Now, we may want to play the rally very short term, like a position trade, 2-3 days or maybe less, but we got to make the assumption that it's just a counter trend move until our daily indicators prove otherwise. So this is kind of where we're sitting. And then one final chart I look at, and I'll just put this out here for you guys. Let me find it. Where are we here? Here we go. In the treasuries, let's take a look at bonds. Bonds is sitting right between no man's land, and we're sitting in this real heavy resistance area here for bonds. So I'm going to be looking at more shorts. I've been an underlying short in bonds for quite some time. And now we're sitting at this level here, but this is a key resistance point right here. I think if we break up, it's not going to run up much, and you're going to see more and more people jumping in on shorts, pushing it back down. So if you get in here with the idea of it moving down, well, I think in time you're going to be right, but be prepared to ride it out in some of this stuff right here. And roll in if you play options, roll it over. If you play futures, just be very careful with this until we get a clear confirmed down move on this. But we are reaching a saturation point, I think, in interest rates. And you can see we took out a key 200 EMA here. And we've got a flat trajectory on the 200, an upward vector on the 50. So these two are going to converge somewhere in this area here. We're going to have a moment of truth. Now, this down move, guys, it may take us through the summer. You've heard the old adage, sell in May and go away. So volume drops out as we go in the summer. We may have traders say if we finish the month down, the entire month down, then we may just say, they're going to go on vacation and look to get back in when they come back in August, September. And that would not be unusual. And we're just going to have chop, and then the market finishes strong in the year. So that's just another plausible scenario. We don't know which way it's going to go. We're going to let the price action dictate, and then we're going to follow along. You can't guess, but you can make some assumptions. And we're going to use near term or shorter term indicators to help us with that. Folks, for those of you that are not members, I'd check out what we're doing. We got a lot of really cool things coming up. We've had a couple of really good 3 or 4 years of run. We're starting off 2014 nice. Every straddle we put on has been successful. We've played a number of good trades. And I suspect it shouldn't be any different going into the summer months. We're still playing some great markets in the commodities as well, and I suspect it's going to continue that way through the summer months into the fall time, summer through fall. So if you're not a member, I'd check us out. I'd encourage you to come on in or send me a note. Let me know what you're thinking. Otherwise, have a great remainder of the weekend. Hopefully your weather's as nice where you are as where I am. And for our members, I'll see you tomorrow night on our Sunday night edition as we look at the week coming up. Have a really great time, folks, and I'll be in touch. Bye now.